All right. Good morning, everyone. My name is Jennifer Radman. I'm a head of investments at Caldwell and the lead PM on our Canadian Value Momentum Fund. We'll be referring to it as the CVM for short, and then the U.S. Dividend Advantage Fund, QSTAF for short. So two strategies we'll be talking about today. And I'm joined by William Chin. He's our head of macro, chief technical analyst, and runs the Tactical Sovereign Bond Fund, which he'll also be talking about today. So Willie's going to start giving a macro and how he's positioned on the fixed income side. I'll then get into the CVM and QSTAF, how we've been navigating this market and how we're positioned today. We'll then get into some questions that we're frequently being asked in today's market. So Willie, over to you.
Thank you, Jennifer. Good morning, everyone. Welcome to the call. First, an overview. By now, we are all aware of the impact this pandemic has on our daily lives. And through these unpleasant changes, we can also envisage its impact on the economy. In this call, we will try to understand the impact and by identifying signposts to help us plot a course through the turbulence and see where all this will lead us to. Now, the shutdown is a self-induced recession aimed at slowing down the spreading and the number of infections to the extent that the healthcare system stays intact. In the past week or so, there has been a clear trend developing that the rate of increase in the spreading of the virus and the associated deaths is slowing. The trend is showing that it is slowing down, and the rate of increase is slowing down. Now, this is a useful signpost, although such data are at least 14 days behind because of the incubation period. Now, more damage will most likely be inflicted to the economy because of this self-induced recession. But markets at one point were pricing in the worst with no clarity as to how this crisis will end. Along with the progress in medical research, which are very useful signposts, there is now more clarity. Incrementally, sentiment is improving. As such, incoming economic data are not useful signposts because of the time lag and that the worst has been discounted by the market. Let us take a look at the US employment data as an example. US weekly jobless claims this morning, I think, was 5.5 million. And to put these numbers in perspective, the Federal Reserve Bank of St. Louis at one point, this is several weeks ago, estimated up to 49 million job losses for the US. Roughly a 30% unemployment rate for the 164 million people in the labor force. The St. Louis Fed called this a back of the envelope estimate, and they did that likely during the height of fear. And central banks and governments, luckily, are fully aware of the need to help households. Now, by hitting the pause button, cash flows in businesses were severely impaired. Within weeks or at the most a few months, most businesses would face insolvency. Governments need to replace such cash flows and make sure businesses remain solvent when the shutdown is lifted so they can get back up on and carry on. Central banks are making sure that credit will flow, and governments are putting on fiscal programs to help businesses stay solvent. Local governments are vulnerable as well as tax revenue evaporates. The conclusion here is central banks and governments, what I call, get it. This is a useful signpost. The delivery of these programs might not be perfect, but the worst will likely be avoided. To recap, the society, the economy, and the financial markets were plunged into extreme fear and uncertainty as shutdowns were imposed. And that can be seen in the sharp declines in risk assets, including stocks. In the past 2 weeks, progress in the fight against the virus spread, what they call flattening the curve, means more clarity in the ability of the healthcare system to bring it under control. Now, these are good signposts. At the same time, advances in medical research provides us a clearer schedule and the time required before returning to normal. Assets, therefore, are on better footing. We started with J&J announcing a vaccine would be available in early 2021, and this was news from roughly 2 weeks ago, to just yesterday, the World Health Organization said there are now 70 companies working on vaccines. Now, these are extremely helpful signposts. A vaccine will probably come hopefully ahead of the early 2021 time schedule set by J&J. Now, my estimate is there will be more fiscal programs and central bank programs. Using the US as an example, and purely for discussion purposes, because we do not know how everything will progress, it is likely going from the current 10% of GDP to around 20% of GDP, these programs. If GDP declines by 10% for all of 2020, government programs totaling 20% of GDP would be what is needed to replace the 10% loss, mostly due to a lower velocity of circulation of money and a lower propensity to consume, even when we restart. Now, consumer behavior will likely be permanently changed in certain sectors, which would drive the business sectors as well. Now, I believe there also will be profound changes in behavior among businesses. Now, here at Caldwell, we are working on a thematic approach to sector selection in equities going forward. We are constructive because central banks and governments get it, and also we are being selective because behavior will be changed. These are my comments, and I pass it back to Jen.
Good. Thanks, Willie. So we'll get into the Caldwell Value Momentum Fund, and just a quick reminder here of what we're trying to do with this strategy. So here we're looking to own stocks that are experiencing a positive re-rating by the market, usually from company-specific catalysts. So one, there's something good happening at the company. Two, the market has already started to recognize it. And then three, we see continued runway in that opportunity. And then once those stories play out, we rotate into the next opportunity. And so that translates into a lot of what we talk about when we talk about this strategy. So a concentrated portfolio, there are only so many companies at any given time that exhibit these characteristics and have the opportunity to meaningfully re-rate. Higher turnover, higher active share, low correlation to the TSX, good down capture, and a skew to small mid-cap names. So that's a strategy. Just to touch on that piece on company-specific catalysts. So clearly we're not in a market that is bottom-up driven. And so we've seen a drastic change in those company-specific catalysts from what we were receiving even 2 months ago versus what we're seeing today with all these COVID. And so that warrants a pretty significant change in the portfolio, and that's exactly what we've been doing. I'll take a comment from the monthly that we just put out. And so we use an analogy, our CEO is a canoer. And if you take the river as an analogy to the market, sometimes the river is smooth, you can look far downstream without having to change course. But once that turns to rapids, you have to adjust pretty quickly and have the flexibility to adjust to what the river throws at you. And so that's how we see the markets, and that's exactly what the Value Momentum Fund is designed to do. And so year to date, our portfolio turnover, just 3 months and a little bit into the year, is already at about 100%. The portfolio looks significantly different today than at the start of the year. And so let's get into that. So in terms of exits, we've had 9 exits so far this year. Earlier in the year, as this started to unfold, exited Air Canada, Parex Resources on the energy side, Bausch & Health, Empire, which we exited prior to them seeing kind of the benefit to grocers from this COVID stuff, exited EQB and Go Easy on the lending side, Parkland and Boyd, not a lot of people out on the street, so really impacting their businesses, and then lastly, Aecon. So 9 exits to date. We've initiated on 8 new positions. And so this is the thing about the strategy. It really highlights what's working in the market, where funds are going and where money is rotating to. And so the first big group that we see is software names. So we initiated an Altus group at the very early part of the year before this COVID started. They're a software provider to the commercial real estate industry, and really seeing a lot of demand with this disruption, the real estate investors really needing to understand their properties and what's profitable and what's being impacted. And so a lot of demand for that software there. Kinaxis, that's a disruptive software on the supply chain planning side. And so that company talked about simulated scenarios through their software have doubled in the last little while. And just as a reference on how sort of ingrained they are, they work with some pretty big companies, Unilever, Ford, and they spoke to 10 billion scenario calculations in terms of the supply chain planning going on. And then lastly, on the software side is OpenText. We initiated on that a few weeks back. And so you have your enterprise information management. And the thing with all these software names, you have the higher recurring revenue component, more visibility in earnings. And a theme that we really see is with this COVID-19, they're really accelerating trends that were already in place prior to the outbreak, and certainly software as a way for businesses to just simply run better is something that we see benefiting from this. So 3 initiations there. The 4th is Stantec, and then Toromont. So those are on the infrastructure side, and then we've also added Quebecor, Loblaw, and Northland Power, and so some pretty defensive names there, some yield focus, and so those holding up relatively well. Cash position today is about 18%. We were down at about 10% a couple of days ago, and then trimming some positions into the rally over the last couple of days. And really the game plan of this strategy is to rotate out of where we're seeing weakness and into strength. And so we're always kind of staying with the market, not getting too far offside in either direction. So in terms of what the portfolio looks like today, top 10 holdings right now are Alimentation Couche-Tard, Real Matters, and it's interesting, so it's a pretty concentrated portfolio, and if you look at sort of into the first quarter of the year, there were only 10 stocks on the TSX that had a positive return. One was Real Matters, one was Metro, and both were holdings in the strategy before the year even began. And so it's just a testament of how this strategy allows us to pick up on what's working. And so Real Matters, they've essentially built a Uber-type platform that connects lenders on one side with the credit and title people on the ground in the mortgage process. And so with rates coming down as they have, they've really been active in their press releasing and saying business as strong as they've ever seen it. And so some very strong performance there. Cargojet as well, they run the overnight air cargo planes. They've actually started to do some scheduled flights from China, bringing in PPE equipment. And so that's something that has just started for them. And we see pretty good demand keeping up. And so that's performed well. WDO, West Dome Gold, 4th largest holding. We talked about Altus Group as the 5th largest. Number 6 is Stantec. Number 7 is Metro. Number 8 is OpenText. Number 9 is Toromont, and number 10 is B2 Gold. And so those top 10 account for about 60% of the portfolio today. In terms of sectors, we're still pretty balanced today. Industrial is about 17%. Consumer staples is at 15%. Financials is at 12%. Note that there are no banks or lifecos in that financials bucket. So looking very different, and Real Matters is sort of a big piece of that. Along with Brookfield Asset Management. Technology at 11%, and between West Dome and B2 Gold, we have approximately 10% of the portfolio in gold today. So going forward, we'll continue to adjust the portfolio as we have been. So when we're looking forward and looking to come out of this period, the portfolio will shift and start to reflect the new norm going forward. So On to QSTAF now. So this strategy is now a completely different beast than what we just talked about in the Value Momentum Fund. And so the difference being, you know, a meat and potatoes portfolio here versus something more opportunistic like we just talked about, but very complementary portfolio and strategy to the CVM. And what it's designed to do is own U.S. companies that can compound the value of their business over time, anchored by a favorable dividend policy and really dividend growth policy. So we're more looking for those companies that can grow in value, where the dividend grows with it, and a lot of academic research showing that better both for returns of the portfolio in both up and down markets, especially versus a pure kind of yield focus. And so and the thing about that dividend growth, it creates this capital allocation discipline in the mindset that comes with that. And so these are companies that are some of the best managed companies in the world, strong positions in attractive industries. Historically, it's these types of companies are the ones that best navigate these types of downturns and disruptions, and therefore come out of these periods relatively stronger than peers. And so you're looking for continued or maybe an acceleration in their market share, profitability, growth prospects becoming even stronger. And so many of these companies in the portfolio have acquisition strategies themselves and have the ability to take advantage of dislocations. And so we really haven't done much to reposition that portfolio through this time. So to how we're positioned today, very balanced on a sector basis. We have about 10% in consumer discretionary. A lot of that is McDonald's. That's holding up relatively well in this environment. 13% in financials, mostly from S&P Global and Marsh & McLennan. And so on the debt ratings and advisory side, 25% of the portfolio in healthcare. That's our second largest weight overall. You have names like Johnson & Johnson, United Health, two companies that had pretty good earnings results over the last couple of days, CVS, and then Cooper Companies, which is a very sort of neat pure play on the contact lens trends. Industrials is 11% in the portfolio. L3 Harris is the biggest weight there. Technology, so the largest weight in the portfolio at 28%, names like Microsoft, Motorola Solutions, Broadcom, Oracle, and Visa and MasterCard is in there as well. Minimal cash in the portfolio today, and just to run through the top 10, they account for about 45% of the portfolio. So we have Microsoft, Motorola Solutions, United Health, Johnson & Johnson, McDonald's, L3 Harris, Cooper Companies, CVS, S&P Global, and Oracle. So with that, we'll get into the some of the questions, and we thank you, those advisors on the call that have submitted some of these questions and some of the common ones we get. So I think I addressed that. We'll skip to the next one. All right, so the decision-making process on when to hold cash, when to deploy it, given fundamentals are so uncertain. So I'll take the first one. Willie can answer the second one on kind of how we use technical analysis. And I'll really refer to the CVM here just because that is our active strategy. So it's really bottom-up driven on where we go to cash and when we go to cash. And so the strategy has a quantitative model that really is the backbone of the strategy. But we do have quite a bit of flexibility to override that quant. And so when we talk about the strategy, is really marrying the best of the discipline of a quant, where you can fall back on something and really helps get the emotions out of the way, which is very important in a market like we have today. And so we have a buy and sell signals coming from the quantitative side of things. And so that really drives a lot of the decisions that we make. And so cash is more of a function of bottom-up decision-making as opposed to us saying, hey, we want to target a certain cash level. And so, yes, fundamentals are very uncertain. We talked about how we've sort of been adjusting to that and kind of gave a flavor of where we in the market feel fundamentals are holding up better than in other places. So, Willie?
Yeah, so I will take the second question. Are you using any technical analysis to help identify when stock prices may be nearing the bottom for specific companies or the equity market in general? We always use technical analysis. And what we have found during this period of uncertainty, when investors get emotional, technical analysis becomes even more important. And as the first question referred to, when fundamentals are uncertain, you really need to gauge the emotions of the market participants, and that can be read through technical analysis. It has been extremely helpful for us. And with good technical analysis, you can actually turn volatility into your friend. You can capture the movements, and that will be favorable to you.
Okay, next question. So how are we evaluating estimating earnings and cash flows during this period? So that's a great question. I think what you're seeing, though, in why different companies and stocks have behaved in dramatic fashions is there's so much uncertainty right there. I think it's safe to say that most of the next few quarters, if not the rest of the year, has been written off. And so when people do their discounted cash flow analysis, looking at the operating earnings in the numerator, there's a lot of uncertainty on what that looks like and for how long and so forth. And so that's why, if you don't know what that numerator looks like, you start putting a higher discount rate in the denominator. And I think that's why for stocks that are most exposed to directly to this COVID impact, so you think about something like an Air Canada, hotels, you have a lot more uncertainty, and therefore I think that's why you've seen sort of the prices drop off a lot more. Those companies like the software stocks we talked about, they have that recurring revenue component. It's maybe a bit more predictable on what their cash flow looks like, and so you haven't seen that much of an impact on their share prices. And so I think the market, if you're just looking at that, it kind of gives you a little bit of the answer there. So the fear of picking individual securities at this time, hard to say kind of which companies have the cash or credit available to withstand the storm. So on the two-step strategy here, balance sheets are very important to us. We like companies that have strong balance sheets, and it sort of works two ways. One is, you don't have that risk of kind of insolvency, but on the second side, there's a lot of opportunities created by this market disruption. And so if you have that balance sheet flexibility, you have a lot more flexibility in terms of what you're able to kind of take advantage of different situations, whether it's acquisitions or making counter-cyclical investments and so forth. And so that's why if you look at the portfolio, very strong balance sheets is important to us. So I think that positions a lot of these companies well. And a lot of them too talk about, when things were good and you had low credit spreads, a lot of them talking about, getting pressure from different shareholders on why not leveraging up the balance sheet, because if you're a bit more leveraged, you have better return on equity. And so a lot of these management teams, especially if they have their own skin in the game with sort of equity in the company, they really push back on that, and now that's coming back to be a very good decision. And so it just speaks to kind of the quality of the management teams, and they're sort of sticking to their game plan, and so I think we're in a good position there today. And then the second question there is, how are you using this in your investment selections? I think going forward, that will continue to be the case. I think the initial downturn sort of maybe overly penalized some of these companies with maybe more aggressive balance sheets. But I think with all the stimulus that Willie talked about, I think that credit is very much available to a lot of companies, and so maybe some that have gotten punished in the original downturn, maybe that was a bit overdone. So next question, please.
The question is, given William's technical, what are his thoughts on the odds of retesting the market bottom experienced in late March? If you look at the weekly chart, where I use candlesticks a lot, and for those who are receiving my daily updates, they would have seen that chart. The weekly chart of the S&P 500 put in a key reversal week, a very powerful reversal pattern, and then followed by good momentum in the last week or two as well. Given that, that is a credible bottom. I think the odds of retesting the market bottom is quite low, maybe 25%. Mostly because when we hit the March lows, the market was everybody's in complete fear. There was no clarity at all. We don't even have any kind of timetable when we will come out of this. And then as gradually, as I mentioned in my earlier comments, J&J come up with a timeline for the vaccine, maybe early 2021, and then more and more companies are coming out with both treatment drugs and also working on vaccines. Now the timetable of returning to some sort of normalcy is becoming clearer and clearer, and that is why I don't think we will retest the market bottom in late March. There could be periodic, downticks as markets react to economic data or maybe earnings, but a lot of that has been discounted in the March low. So I don't think we'll retest the low, and actually we are quite constructive both technically and from like a fundamental basis, from a macro basis. The second question is, will market movements be largely driven by earnings or some other catalyst? And I would tie that into another good question raised, is what are the signposts, useful signposts going forward? And earnings is going to be negatively impacted, of course, due to the shutdown. But markets try to look forward, and the way to discount the future, to predict the future, is really looking at medical research, the timetable of vaccines coming out, the increase in the medical capacity of the healthcare system in testing. Testing is extremely important. If the testing capabilities can be vastly increased, it will speed up reopening. Now, having said that, there will not be, I don't expect a kind of a V-shape and then several months later everything back to normal. As I mentioned before, we are taking a thematic approach. Consumer behavior, business behavior will be changed. For example, airlines, restaurants, cruises, to pick the obvious examples, those, it may take a long time if that get back to normal. But technology companies, healthcare, and I think we talk about government spending a lot of money on fiscal programs, and what best way to spend your fiscal dollars than infrastructure? And the US and even in Canada, we need infrastructure spending, and that is one of the reasons I think we have construction companies in our portfolio.
Next question, please.
The next question is, please provide your expectations for the Canadian dollar, inflation, and interest rates moving forward. So that's quite a mouthful, but I will give you a quick breakdown. The Canadian dollar, of course, with the challenges in the crude oil market, and while we are talking about the G7 and the G20, how we are dealing with this pandemic. A lot of people have been like, we should actually look at the emerging markets as well. Emerging markets have less resources, more reliable on export, more reliable on commodities. So in a global environment where trade is challenged, the Canadian dollar usually would be weaker. And I also expect, because the U.S. is more aggressive in helping the economy coming out of this, the U.S. will probably recover a little bit faster than Canada. And as a result, I expect the Canadian dollar to be weaker versus the U.S. dollar. Inflation, the intuitive interpretation is, well, the central banks are printing so much money, therefore it will be inflationary. Actually, it is a two-step process. Step one is central bank printing money and fiscal program are simply replacing lost wages, lost revenues, lost cash flows. So in this stage, it will not be inflationary. If the government, if the central bank overdo it going forward by a large extent, then you have too much money chasing after too little goods and services, then there might be a period of inflation. But you need the economy to grow for inflation to be sustainable. Otherwise, you have stagflation. And then after stagflation, usually inflation will come back down as well because of lack of growth. So that would be my forecast on inflation. Interest rates, in general, you can kind of summarize the global around the world, short-term interest rates are pegged at or near zero. And Japan and the EU, they're negative. If you have the short rates at zero, your 10-year yield should roughly be between 75 basis points to maybe 1%. That is a reasonably steep yield curve, but of course that is because the short-term rate has been pinned to zero. And the yield curve will continue to slope, to be positively sloped, simply because there will be large amount of government borrowing and also decline in tax revenue.
Next question, please.
Yeah.
Is there another question?
Yeah, I think.
No, so that seems to be it. Okay, well, thanks everybody. Thanks for calling in. And if you have any questions about what we covered today or anything else, contact your sales reps or William or myself directly, and we'll get you an answer. So stay safe out there. And this concludes today's call.